So imagine looking at a company that fundamentally loses money on every single dollar it makes. Like a company that literally pays for the privilege of selling its own product right now.
Right, which is wild to even think about.
It is. And now, imagine that same company's stock
Yeah.
has this rabid retail fan base calling for a 400% price explosion by next year.
Oh, absolutely.
I mean, I'm looking at the stack of sources you brought for today's deep dive, and there is literally a YouTube video title screaming QUBT to $50 by 2026 with a giant rocket ship emoji.
Yeah, the rocket ship really ties the thesis together, doesn't it?
Oh, totally. But then right next to that video, we have these dense financial statements that look like they belong to a distressed local business that's about to go under. So welcome to the alternate reality of quantum computing, Inc.
It really is a fascinating paradox. I mean, the whiplash between the technological narrative being spun in the market, and the hard financial realities on the balance sheet, it's extreme.
Yeah.
You rarely see this level of cognitive dissonance trading on a major exchange.
And just to ground us in the reality of right now, for everyone listening, today's May 23, 2026, we are looking at this company, ticker symbol QUBT. The stock just closed around $12.31.
Right.
And at that price, the market is valuing this enterprise at a massive $2.78 billion.
Which is an incredibly steep premium when you dig into the underlying cash flows.
Okay, let's unpack this. Our mission for today's deep dive is straightforward. We really need to figure out what exactly you, the listener, are looking at with QUBT.
Exactly.
Is this actually a generational tech play? Like, are we on the verge of a massive breakout that validates that $50 price target?
Yeah.
Or is this a highly speculative bubble masquerading as a blue-chip tech stock?
Which is the billion-dollar question, literally.
Literally.
Yeah.
So we're going to cut through all the hype, look at the actual physics of what they're building, tear down the financials, and map out the specific market forces driving this stock.
But to do that properly, we really have to start with the physics. Because before we can even begin to evaluate a multi-billion-dollar valuation, we have to understand what this company actually does to make the market so, aggressively optimistic.
So QUBT, Quantum Computing, Inc. Despite the really broad name, they aren't building those giant chandelier-style quantum computers most people picture when they hear the word quantum.
No, not at all.
They're specifically a quantum photonics and integrated optics company. And their entire strategy revolves around this lab-to-fab approach.
Yeah, lab to fab is the crucial phrase here. They are attempting to take highly theoretical, laboratory-bound quantum concepts and fabricate them into commercial mass-market products.
Okay.
And the foundation of that entire strategy is their investment in a thin-film lithium niobate photonic chip foundry.
Thin-film lithium niobate, or TFLN. I want to pause here because this is where the hardware story gets incredibly interesting. Lithium niobate is essentially the silicon of the photonics world, right?
It is, yeah. If you want to process information using light rather than electricity, lithium niobate is the miracle material.
Right.
Because of its unique electro-optic properties and its crystal structure, it allows engineers to modulate light at incredibly high speeds. We're talking gigahertz or even terahertz frequencies.
Wow.
And it does this without losing the photons or generating excessive heat, which is a huge bottleneck for other technologies.
And that leads to their massive differentiator. Because when you look at traditional quantum systems, particularly the superconducting qubits being developed by the legacy tech giants, they require environments that are just like fractions of a degree above absolute zero.
Yes, the dilution refrigerators.
Right. You are basically trying to maintain an artificial, super cool iceberg in the middle of a desert just to keep the qubits from losing their quantum state.
Exactly.
The energy footprint is just astronomical. But QBT is using photonics.
Right, and this is where the narrative gains real traction. By using photonic qubits, essentially manipulating light QUBT systems can operate at room temperature with relatively low power.
So to build on that, if traditional quantum is this delicate iceberg, QUBT's tech is basically just using a normal flashlight. You don't need a multi-million-dollar freezer.
Yeah.
You're just shining light through a chip.
Well, the flashlight analogy gets us halfway there, but it kind of misses the sheer complexity of what's happening on the physical chip.
Fair enough.
It's not just shining a light. It is more like trying to thread millions of microscopic laser beams through a prism, bending and splitting them at the speed of light without a single beam bleeding into another.
Okay, that's a bit more intense than a flashlight.
Just a bit. But your broader point is completely correct. It removes the need for the freezer. And that changes the entire commercial trajectory of the industry.
How so?
What's fascinating here is how it connects to the bigger picture. The broader quantum market is projected to be worth up to $150 billion by the 2030s or 40s.
150 billion.
Right. Touching artificial intelligence, cryptography, massive logistical optimization, everything.
But, the longstanding joke is that quantum computing is always a decade away, and it will always be a decade away.
Which is exactly the stigma QUBT is trying to break. Because their technology operates at room temperature, they are focusing on practical, application-oriented hardware that can be deployed right now.
So they aren't going for the sci-fi stuff right out of the gate.
Exactly. They aren't trying to build a universal quantum computer that can break modern encryption tomorrow. They are building things like reservoir computers.
Let's define that for the listener, because reservoir computing still sounds like something straight out of a sci-fi novel.
I know, the terminology is wild. It's essentially a type of neural network computing that excels at pattern recognition and processing time-dependent data.
Okay.
Instead of needing perfect, error-corrected logical qubits, which is what the giant supercooled machines are trying to achieve a reservoir maps inputs into a complex, higher-dimensional space.
The reservoir.
Exactly, the reservoir. And it's incredibly efficient for specific AI and machine learning tasks. QUBT is combining this with LiDAR solutions and quantum networking products.
So it's hardware that fits into a standard data center server rack today.
Yes.
So if I'm looking at the core bull thesis here, is this room temperature, rack-mounted capability the sole reason the market is projecting a multi-billion-dollar future for this company?
It is the foundational pillar, yes. The market is looking at a massive future total addressable market and concluding that whoever solves the hardware bottleneck, whoever makes quantum practical, portable, and scalable, wins the lion's share of that $150 billion.
And QUBT is the front runner.
QUBT is presenting a scientifically validated argument that thin-film lithium niobate photonics is the most viable path to that scalability.
Okay, the technological ambition is just phenomenal, but building commercial-grade photonic hardware and constructing a proprietary foundry requires a colossal amount of upfront capital.
It really does.
Which brings us crashing into the financial reality. The tech sounds like the year 2035, but the financials look like a distressed asset today.
Yeah, the transition from the laboratory to the fabrication plant is brutally expensive.
Let's look at the headline revenue growth that the retail bulls are cheering about right now. In the sources, QUBT is reporting a trailing 12-month revenue growth of over 1,000%.
Over 1,000%.
Right. And when you hear 1,000% growth in a high-tech sector, you naturally assume the product has hit mass adoption and chips are just flying off the assembly line.
That is the danger of relying on percentages without looking at the absolute baseline numbers.
Because in Q1 of 2025, their quarterly revenue was $39,000.
Yeah.
And I want to make sure the listener heard that right. That is not a typo in our notes, $39,000. That is the price of a mid-sized sedan.
Pretty much.
And that was the entire quarterly revenue for a publicly traded quantum computing company.
It's microscopic. Now, by Q1 of 2026, it did jump to roughly $3.69 million for the quarter. But even with that explosion in growth, their trailing 12-month revenue sits at just $4.33 million total.
And we really need to dig into how they achieved that growth, because from what I'm reading, it wasn't a sudden wave of organic demand for their proprietary TFLN chips, right?
No, not at all. That revenue spike was largely engineered through recent acquisitions.
Right. They bought a company called Luminar Semiconductor, which gets them into the autonomous driving and LiDAR space.
Mm-hmm.
And they bought NuCrypt to acquire quantum encryption technology. So they are basically consolidating the revenues from those acquired companies, along with some very early output from their first fabrication facility, Fab 1.
Exactly. They are essentially buying their way to early revenue while they wait for their core technology to mature.
Which makes sense on paper.
It does, but while rolling up smaller companies builds the top line, it doesn't fix the underlying unit economics.
Oh, let's talk about those unit economics, because profitability is basically non-existent. They have a trailing 12-month net income of negative $39.71 million.
Yeah.
But the metric that really stops you in your tracks is the gross margin. It is negative 15.39%.
Yeah, which means they are losing money before they even pay their executives or keep the lights on in the corporate office.
Exactly. How does a deep tech company operate with negative gross margins? I mean, it literally costs them more than $1 in raw materials and direct manufacturing labor to deliver every single dollar of sales.
It's painful to look at.
They are paying customers to take the product.
Well, it really comes down to the realities of standing up a new semiconductor foundry. In a new facility like Fab 1, you're manufacturing yields, so the percentage of chips on a wafer that actually work are incredibly low.
Oh, right.
You might ruin a dozen chips to get one viable one. So the fixed setup costs, the raw lithium niobate, the specialized labor, all of that cost is absorbed by a very small number of sellable products.
Gotcha.
It is the classic valley of death for hardware startups.
Yet despite making roughly $4 million in sales and losing nearly $40 million to do it, you look at the balance sheet, and they are sitting on a mountain of cash.
A massive pile of cash.
Market data shows they hold nearly $1 billion in cash and equivalents, with virtually zero debt. Just $5.45 million in debt.
It's an ironclad balance sheet, which is rare for a company burning through capital this quickly.
But I have to push back here. How does a company with the revenue of a successful local restaurant stockpile almost $1 billion in cash without taking on debt?
I think we both know the answer to that.
We do, and it is brutal for retail investors. 74% year-over-year share dilution. Their shares outstanding jumped to over 225 million shares.
Yeah.
So every time a retail investor buys a share, their slice of the pie is actively being shrunk by the company printing more shares. I have to ask, are investors essentially just functioning as a massive ATM for management while they wait and hope for the tech to eventually work?
That is the harsh reality of investing in QUBT right now. You have to recognize that this is basically a venture stage startup that happens to trade on the public market.
Right.
When a private VC-backed company needs runway, they do a Series B or Series C funding round. QUBT uses the public markets instead.
Wow.
The massive dilution is the cost of their multi-year runway. They are burning tens of millions of dollars a year on research, development, and building out the chip foundry. They are selling equity to buy time.
And because they are public, they attract everyday retail investors. And because they attract retail investors, we have to look at how they are being valued by traditional investing metrics.
Oh boy.
Which is where the numbers completely detach from reality.
Yeah, if you attempt to apply any traditional value investing framework to QUBT, the entire structure just collapses.
Take the price to sales ratio. The PS ratio is sitting around 640x.
640.
Right. And to put that into perspective for our listeners, a PS ratio of 640 is staggering, even by the most euphoric Silicon Valley standards. At the absolute peak of the 2021 software bubble, top-tier SaaS companies with 80% gross margins and highly predictable recurring revenue were peaking at maybe 50 to 100 times sales.
And that was considered a massive bubble.
Exactly. And QUBT is asking you to pay over 6 times that premium for a hardware company with negative gross margins. To make this relatable, it's like buying a neighborhood lemonade stand for $6,400 when it only makes $10 a year in sales.
And it actually loses money doing it.
And it loses money. So let's look at Phil Town's Rule #1 valuation framework, often referred to as the payback time test, which comes up in our sources. It's a great tool for grounding these astronomical multiples. Can you explain the core logic there?
Sure. The foundational concept of payback time is that a business must have a track record of predictable, positive earnings.
Okay.
The investor's goal is to project a realistic payback period. Basically, if you were to buy the entire business outright today and take it private, how many years of its generated profits would it take to pay you back your initial purchase price?
And obviously, QBD fails step 1 immediately because they do not have predictable earnings. They have wildly unpredictable, deeply negative earnings.
They do. But to truly illustrate the valuation disconnect, analysts often run an incredibly aggressive hypothetical projection just to see if the math could possibly work under perfect conditions.
Let's run that hypothetical scenario for the listener.
Okay, let's pretend that QEBT is able to scale its lab-to-fab strategy flawlessly and grows its revenue by 50% every single year for the next 10 years.
50% every year for a decade.
Right. Furthermore, let's pretend they miraculously solve their yield issues, flip those negative gross margins, and achieve a highly optimized 25% net profit margin on all future sales.
Which would be a historic Harvard Business School case study level of corporate execution.
It would be legendary. But even in that ultra-bullish scenario, if you calculate the total net profit generated over that entire 10-year period, it comes out to roughly $123 million.
That's barely anything in the grand scheme of things.
Exactly. The market cap today is $2.78 billion. So even if they execute a flawless decade of hypergrowth, the total profit they generate is merely 5% of what the market is asking you to pay for the company today.
Wow. So if you are a value investor looking for a margin of safety, QUBT doesn't just fail the test, it gets laughed out of the room.
Completely. Based purely on fundamental cash flow analysis, the theoretical buy zone for this stock wouldn't be anywhere near $12. It would be in the $1 to $2 range. From a strict value investing perspective, this is a glaring don't buy, don't hold.
But here's where we have to pivot.
Yeah.
Because if value investors would run away screaming from a $12 valuation, we have to address the other side of the market. Why are analysts giving it a consensus buy rating with price targets averaging $17.83?
Right.
And why are the momentum traders on YouTube drawing rocket ships and talking about a path to $50? If the fundamentals are screaming no, what exactly is this other faction of the market seeing?
We are shifting from the value investor's playbook to the speculator's playbook. The market isn't acting entirely irrationally. It is just playing a completely different game, one based on market mechanics rather than discounted cash flows.
So it's about the technical picture, which is incredibly volatile. Our data shows QUBT has a beta of 3.70. For context, the broader S&P 500 has a beta of 1.
Right.
So a beta of 3.70 means this stock swings nearly 4 times as violently as the overall market.
It's a high-frequency trader's dream. And from a charting perspective, it recently crossed above both its 20-day and 50-day moving averages.
Which signals a strong short-term uptrend.
Exactly.
But the real explosive potential lies in the short interest. Over 26% of the outstanding shares are currently sold short.
Which is huge.
More than a quarter of the market is actively betting that the stock will crash.
And that is exactly what creates the coiled spring effect. When you have that much short interest in a stock that is suddenly experiencing upward momentum, you create the optimal conditions for a massive short squeeze.
Let's break down the mechanics of that, especially around the options market. Because if you look at the options chain right around the $12.50 to $13 mark, it is a massive battleground right now.
Right. Because if the retail bulls and momentum algorithms can push the price decisively through that $13 strike price, a wave of call options suddenly become in the money.
Okay.
The market makers who sold those options are then forced to buy the underlying stock to hedge their exposure. That's a gamma squeeze.
Right.
Simultaneously, the short sellers who bet against the stock start facing margin calls. They are forced to buy shares at market price to cover their losing positions.
Oh, wow.
So that combined buying pressure pushes the price up even higher, forcing more shorts to cover and more options into the money. It's a feedback loop.
So a run to $20 or even $50 might have absolutely nothing to do with QUBT selling a single new quantum chip and everything to do with forcing short sellers to liquidate.
Precisely. It is a game of market plumbing, but the speculators aren't just relying on technical squeezes. They also have a massive macro narrative acting as a tailwind.
Ah, the government intervention. The U.S. Commerce Department has earmarked $2 billion to develop the domestic quantum industry. Because quantum computing isn't just about faster software, right? It is a critical national security imperative.
Oh, absolutely. The ability to break modern cryptography or secure communications, which, by the way, ties right back to QUBT's acquisition of NewCrypt, is something the defense sector is throwing billions of dollars at.
And historically, when a deep tech sector transitions from a niche science project to a matter of national security, the entire industry experiences a macro re-rating.
Exactly. Government contracts, defense deals, and non-dilutive grants can flood a company's balance sheet literally overnight.
So if I'm the listener trying to synthesize this massive contradiction, I have to accept that I am not buying a business based on what it produces today. If I buy QUBT at $12, I am essentially buying a highly volatile, very expensive lottery ticket for what their technology might achieve in 2030, combined with a bet on short squeeze mechanics.
That is the most accurate way to frame it. You have to choose your lens.
Yeah.
For a strict value investor demanding predictable cash flows, positive margins, and a mathematical margin of safety, the answer is an unequivocal no. The math actively works against you.
But for the high-risk speculator?
For the speculator, it is a high beta momentum play heavily tethered to a revolutionary technology. However, anyone targeting that $50 price point needs to understand that it assumes perfect execution.
Which is rare.
Extremely rare. It assumes their TFLN foundry yields improve dramatically. It assumes zero macroeconomic downturns. It assumes they capture those government defense contracts. And crucially, it assumes a market environment willing to keep paying an astronomical premium for the story while they wait half a decade for the actual revenue to catch up.
And as anyone who follows deep tech knows, the path from the laboratory to mass fabrication is rarely, if ever, flawless. There are always delays, yield issues, and unforeseen physics problems.
It is arguably the most difficult transition in modern engineering.
So what does this all mean for you as you look at QUBT today? On one side of the ledger, Quantum Computing Inc. represents the bleeding edge of room temperature quantum photonics. They are pioneering thin-film lithium niobate chips that operate in standard server racks, effectively building the flashlight, while their mega-cap competitors are still trying to keep the iceberg from melting.
That's the bull case.
And they have nearly $1 billion in cash to build out their vision.
But on the other side of that ledger, that narrative is tied to microscopic current revenues, fundamentally broken unit economics, a history of massive share dilution that constantly erodes shareholder value, and a valuation multiple that completely ignores traditional financial gravity.
Which leaves us with a final, lingering question to mull over. We are increasingly seeing highly speculative, pre-revenue deep tech hardware companies go public long before they have a proven scalable business model. QUBT is, for all intents and purposes, a venture capital bet trading live on the open market.
It really is.
So, if public equity markets are starting to act like early-stage VC funds, does the everyday retail investor actually have a mathematical chance to get in early on the next big thing? Or are they simply providing the crucial exit liquidity for the founders and early private investors who need someone to fund their decade-long science experiment?
That is a critical question about the structure of modern capital markets. Identifying revolutionary technology is only half the battle. Understanding who is paying for the research and development phase is the other.
It's the stark difference between riding the rocket ship and just paying for the fuel while someone else takes the trip. Thank you for joining us today, and remember to keep digging into the data behind the narratives. We'll catch you on the next Deep Dive.